Enel SpA is executing a profound and value-accretive strategic repositioning, pivoting toward a defensive growth model centered on regulated electricity distribution assets within its core European markets, Italy and Spain. This shift is anchored by the 2025-2027 strategic plan, which dictates a highly disciplined total gross investment of approximately €43 billion. 1. The allocation strategy is overwhelmingly focused on regulated activities, with over 60% of capital expenditure, CapEx, targeted toward grids. 3. This reorientation fundamentally alters the group's risk profile, favoring stable, predictable regulatory asset-based growth over exposure to volatile merchant generation markets. This strategic focus, which confirms resilience and profitability as core pillars, 1, has already resulted in balance sheet stabilization and improved credit metrics. The confidence derived from projected sustainable cash flows directly supports the enhanced commitment to shareholders, evidenced by the upward revision of the fixed minimum dividend to 0.46 per share. The current valuation multiple is considered justifiable due to the long-term, low-risk, predictable cash flows generated by the large-scale grid investment program. Groups has enhanced ability to generate stable, long-duration cash flows, coupled with superior financial engineering through sustainable finance. The successful deployment of €26 billion into regulated assets in supportive jurisdictions will structurally raise Enel's quality of earnings. The firm's target price is derived primarily through a sum-of-the-parts SOTP model. This methodology allows for the assignment of a premium valuation multiple to the regulated grid segment, recognizing the favorable regulatory environment in Italy, ARERA, 4 that supports predictable asset appreciation. While specific discounted cash flow models suggest a substantial overvaluation, citing an intrinsic value of €3.82 per share 5, this view is deemed restrictive. It is assessed that simplistic DCF approaches often fail to adequately capture the inherent, compounding value of a rapidly expanding regulated asset base and the growth premium afforded to utilities positioned at the forefront of the mandated energy transition. 2. Strategic repositioning, the regulated asset focus, 2025-2027. A. Corporate profile and geographical prioritization. 1. Strategic focus and core markets. Enel is pursuing a strategy designed to foster a more agile corporate structure by streamlining its geographical operations. The group has explicitly focused on 6 core countries for its future investment and activity: Italy, Spain, the United States, Brazil, Chile, and Colombia. 9. This concerted focus reflects management's commitment to enhancing the group's resilience by reducing exposure to non-core, potentially higher-risk markets. 9. 2. Strategic pillars. The 2025-2027 strategic plan reaffirms the 3 critical pillars guiding the group: profitability, flexibility and resilience, and efficiency and effectiveness, all underpinned by financial and environmental sustainability. 1. The emphasis on flexibility and resilience is a direct response to the market need for system stability, especially considering the increased volatility stemming from rapid renewable penetration and extreme weather events. Grids are recognized as critical infrastructure that require increasing investment to integrate growing renewable capacity and maintain system stability. 1. B. The $43 billion capital allocation strategy. The new strategic plan mandates a total gross CapEx of approximately $43 billion, marking a significant $7 billion increase relative to the previous plan, signaling a determined and aggressive investment cycle. 1. This commitment is heavily skewed toward Europe, which accounts for about 75% of the total allocation, with the remaining 25% distributed across Latin and North America. C. Deep dive grids investment as the core value driver. 1. Regulated asset priority. The allocation of approximately €26 billion to the grid segment represents the strategic core of the plan, signifying a 40% increase over the previous investment commitment. 1. This concentration on regulated assets is the primary mechanism for reducing the group's risk exposure and ensuring predictable returns. 2. Jurisdictional risk mitigation. The geographic distribution of the grid investment is meticulously planned, with 78% allocated to Italy, more than 16 billion euros, and Spain, 4 billion euros. 1. This concentration is specifically driven by the existence of favorable regulatory frameworks in these two European nations. 1. The explicit reliance on favorable regulatory environments demonstrates a disciplined approach to value creation. Successful, high-volume investment in regulated assets yields strong financial accretion only when the regulator establishes appropriate conditions to remunerate these investments. Management's confidence in the regulatory regimes of Italy and Spain suggests an anticipation of supportive regulated rates of return, i.e., WACC applied to the growing RAB, thereby ensuring the CapEx deployment maximizes the stability and quality of the group's future regulated earnings profile. D. Renewable generation growth and portfolio management. 1. Capacity targets. The strategic plan commits approximately 12 billion euros to renewable generation, targeting the addition of around 12 gigawatts of new capacity. 3. This expansion aims to increase total renewable capacity to approximately 76 gigawatt by 2027, projecting a total generation increase of over 15% and pushing the share of zero-emission energy production to 86%. 2. Technology mix. The investment focuses heavily on reliable and dispatchable technologies, with over 70% of the new capacity additions dedicated to onshore wind, hydro, and battery storage systems, BESS. 3. Capital light models. To optimize capital efficiency and risk exposure, particularly in non-core countries, Enel employs a robust partnership model. The stewardship model, less than 50% stake, is utilized to leverage the substantial project pipeline, 450 gigawatts, of which 160 gigawatt is advanced, while external partners absorb capital requirements, thereby improving financial flexibility and capital returns. The imbalance in CapEx, 12 billion euros for generation versus 26 billion euros for grids, is a defining feature of the strategy. It indicates a deliberate choice to use the stewardship-partnership models to offload the capital intensity and execution risk inherent in large-scale renewable build-out to external financiers. Enel thus concentrates its owned equity capital on the regulated grids, which are essential for the integration of renewables and offer guaranteed, predictable returns, establishing a lower-risk business profile. 3. Financial performance and solvency assessment. A. Historical financial trend analysis. FY 2023-9M 2025. The group achieved solid results in 2024 and maintained momentum into 2025. Although revenues declined to 78.947 million euros in 2024 from 95.565 million euros in 2023, minus 17.4% due to commodity price normalization, 13, profitability strengthened. Ordinary EBITDA rose to 22,801 million euros in 2024, plus 3.8% year-over-year. 13. This trend continued in 9M 2025, with ordinary EBITDA at 17,262 million euros, plus 0.9% compared to 9M 2024. 6. Group net ordinary income exhibited strong growth, reaching 7,135 million euros in 2024, plus 9.6% year-over-year, and 5,703 million euros in 9M 2025, plus 4.5% year-over-year. 6. B. Segmental operating performance and margin drivers. In 9M 2025, operating performance was heterogeneous. EBITDA was supported by strong contributions from Spain and Colombia. However, this positive momentum was partially offset by margin reduction in Italy, resulting from lower average prices applied to end customers and decreased generation volumes, specifically due to lower hydro availability. 6. The overall positive performance in Latin America, despite negative exchange rate effects, demonstrates geographical diversification benefits. 6. C. Debt structure, solvency, and cost of capital. 1. Leverage reduction. The group successfully deleveraged in 2024, lowering net financial debt to 55,767 million euros, a 7.3% decrease from 2023. 13. Consequently, the net debt-equity ratio improved substantially, moving from 1.33 in 2023 to 1.13 in 2024. 12. Although net financial debt increased slightly to €57,535 million by September 30, 2025, due to capex and dividend payments, this was partially mitigated by positive operating cash flows and new issues of hybrid bonds. Management targets a consolidated net financial debt-EBITDA ratio of approximately 2.5x by 2027, maintaining a leverage profile below the sector average. 2. Credit profile. Enel maintains stable investment-grade debt ratings, BBB, S&P's, Baa1, Moody's, and BB+, Fitch, all with a stable outlook. 15. Regulatory and execution risk deep dive. A. Italian regulatory asset base stability, ARERA review. 1. E-distribution significance. Enel's Italian distribution subsidiary, E-Distribution, is the dominant market operator, managing 85.1% of distributed energy in the country. 18. The financial terms of extending these critical concessions directly affect the valuation of the group's largest regulated asset base. 2. Favorable regulatory clarity. The Italian regulator, ARERA, initiated a consultation regarding the extension of electricity distribution concessions. Initial proposals referenced fees quantified at €3.1 billion. 4. This figure is notably lower than initial, more pessimistic market forecasts that had suggested mid to high single-digit billion euro charges. 5. This favorable outcome substantially de-risks the capital commitment in Italy, which constitutes the majority of the $26 billion grid investment. 1. The low fee structure provides Enel with substantial balance sheet flexibility. Citi analysts noted that this flexibility, estimated at $10 billion in headroom, could be channeled toward either accelerated capital deployment in the Italian network, where capex already exceeds depreciation, implying potential for 10 to 20% further increase, or enhanced returns to shareholders. 4. This positive regulatory signal provides external validation for the strategic plan's focus on Italian grids, confirming the high-return nature of these regulated assets and eliminating a key source of valuation uncertainty. B. Execution risk in renewable deployment. The execution of the 12-gigawatt renewable capacity expansion plan entails risks, despite the use of capital-light models. 1. Primary risks. The principal risks include global inflationary pressures, which drive up procurement costs, and congestion within the supply chain, which can lead to project delivery delays. 1. 2. Mitigation and scale. Enel's scale and centralized project management structure, managing 95% of projects globally, provides significant diversification against local risks. 19. Furthermore, management has secured contained procurement costs for the short-term horizon, over the next 12 months, to mitigate immediate inflationary impacts. 19. 3. Project structuring. The group utilizes the differentiated models, ownership, partnership, stewardship, 11, not only to optimize funding, but also to match risk profiles, thereby managing the execution challenges associated with large, rapid global expansion. C. Financial risk management. Commodity and currency hedging. 1. Currency risk mitigation, Americas. Given the exposure in South American core markets, Enel Americas actively manages exchange rate risk using currency swaps and forwards. The goal is to balance US dollar or local currency financial flows against the underlying currency of assets and liabilities, minimizing exchange rate volatility risk. Debt is also strategically refinanced in the functional currency of each subsidiary. 2. Commodity risk mitigation. The group employs robust commodity risk strategies, including setting sales commitment levels that align with generating capacity, particularly crucial in mitigating risks from extreme drought situations impacting hydro generation. For regulated long-term contracts, indexing polynomials are used to minimize exposure to commodity price variations, thereby protecting results from volatility. 5. Shareholder returns and valuation. A. Dividend policy analysis. 1. Upward revision. The group has committed to an upward revision of its dividend policy, establishing a fixed minimum dividend of €0.46 per share for the plan period, up from €0.43. The dividend proposed for the 2024 financial year was €0.47 per share, demonstrating confidence by already exceeding the new floor. 13. 2. Payout ratio. In addition to the fixed minimum, the policy offers a potential upside linked to group net ordinary income, targeting a payout ratio of up to 70%. The decision to establish a higher fixed dividend floor is a powerful signal of management's confidence in the long-term sustainability and predictability of future cash flows. Since regulated assets provide consistent, contractually backed returns, the massive grid capex deployment ensures stable, growing earnings regardless of short-term market dynamics. This strategic move cements Enel's position as a reliable income provider and a low-risk defensive utility, generating consistent income growth derived from its expanding regulated asset base. B. Relative valuation benchmarking. 1. Current multiples. Enel currently trades at a P/E ratio between 14.4x and 14.7x and offers a competitive dividend yield of 5.35% to 5.52%. 7. 2. Peer group analysis. Enel's P/E multiple, 14.4x, trades slightly above the average for similar peers, 13.5x, and the broader utility sector, 11.9x. 7. This premium reflects the strategic quality of its asset base and its scale in the energy transition. Analyst consensus generally supports the stock, with Barclays maintaining an overweight rating. 21 competitors like Engie, while potentially offering a higher dividend yield, 7 to 8% estimate, trade at a lower estimated P/E, around 10x. Absolute valuation reconciliation and critique. The median analyst target price stands at €8.50, with several buy-side brokers targeting between €9.20 and €10.10. However, the stark conflict presented by a DCF analysis suggesting an intrinsic value of €3.82 requires addressing. This substantial divergence occurs because absolute valuation models often fail to correctly interpret the impact of front-loaded, aggressive capital cycles typical of utility transitions. By prioritizing massive, immediate capex into regulated grids, the company intentionally reduces near-term free cash flow. This phenomenon, which DCF penalizes, is precisely the action that creates high-quality, long-term regulated earning streams that the market appropriately values through a higher P/E multiple. The market premium accurately reflects the value of low-risk RAB growth and the certainty provided by supportive regulatory outcomes, ARERA.